Now, with any condo building that's 10 units and under, there's no review. So that means no budget, no condo questionnaire. If there's litigation, we don't care. The only thing they want is the master policy of insurance. Now, any condo 11 units and over, they're going to do a full review on no matter what. So they're going to get the budget. They're going to get the decks and bylaws. They're going to get a condo questionnaire. But the big change that I think is really going to affect a lot of people in Chicago, because we have so many high rises and condo buildings 11 units and more, is, before in the budget, every year, the HOA needed to put 10% towards reserves. So let's just give an example. You have a condo building and they're bringing in $100,000 a year in reserve income. 10% or $10,000 a year has to be a line item that it's going towards the budget for reserves, okay? Now, starting January 1st, 2027, it's going from 10 to 15%. So that means every single HOA in America that's 11 units and more has to redo their budget, and this is probably gonna make up, HOA bills go higher for everyone.
Yeah.
And it's across the board. And if they don't have it, they're gonna be on that do not lend list, and it's tough to lend in there.
What's the 5 Ps? Do you remember it?
Proper preparation prevents poor performance.
There you go. It doesn't matter how much money we get. If we don't close, it's no money, right? So no close is no money. I'm everything that I am because of my dad's death. And I wouldn't be as successful without his death. Hello and welcome to the Jason Theory. And we are here today with Brad Bowden at Select Lending Services, SLS, which is housed inside Jameson Sotheby's over at 425 North Avenue. Did I get that address right? Because I don't go there.
You did. Yes.
I'm always like 5 something. And we're going to talk about everything that has to do with mortgages, lending money, things that you don't know about, and huge changes that are coming up on the lending. Tell us a little bit about yourself, and then we'll dive right into it.
Sure. As you said, name's Brad Bowden. Been in Chicago since 2005 and been doing mortgages ever since. Grew up in Iowa and met Jason years ago when our kids went to school together, actually.
Yes.
Small world.
2005. I had Vince Anzalone, who I didn't know did loans beforehand.
I didn't know that either.
Yeah.
Interesting.
We were talking about, did you ever see the 100 Days of Summer?
Yes.
I love that. Before I knew
It's a good
Vince.
movie.
No, you're talking about 500. You're talking about you're talking about the movie.
Yes, I'm talking about the movie. What are you talking about?
Vince was on a reality show
called
The 100 Days of Summer.
I did not see that.
It's awesome.
In Chicago?
It's all about the 100 summer days in Chicago and these, early 30 eligible bachelors and bachelorettes and how they party and how it's.
I gotta go Google that.
Oh my God. You could buy it for $2.99 on YouTube because right. I had them and I loved that show. Me and my wife used to watch it all the time. And Vince is out of control.
In his younger days?
But he took the video. It's on the podcast. It's about to drop next month or in a couple weeks. He did the video for the to get the role 2 years before they actually tapped him.
Oh, wow.
So the things he was saying, he was engaged when they started the filming.
Oh, no.
And they were like, hey, we need you to do this and this. And it's like, I can't do that anymore.
I'm not single.
She's like, can you go out on dates? It doesn't, we don't need to. She's like, no. But dude, then the first episode came out. They sent it to him on a CD, DVD.
Old school.
So he was watching the DVD and he watches like, oh my God, this comes out. He's like, she almost left me.
Oh.
He's like, last summer. He's like, man, I slept with 60 women. It was the greatest.
Jesus.
Dude, it's great. Anyways, a sidebar, but
insert foot and mouth.
Yeah, 100 Days of Summer.
Oh, Jesus. All
It's
right.
great.
I'll check it.
All right, so let's get on to, anyways, I was talking to Vince and he's like, listen, he's like, in 08, 09, 10, he's like, it wasn't just a slowdown, it was an absolute faucet turnoff. How did you get through those years? Vince was like, dude, I had to sell my apartment. He's like, I got rid of my car. He's like, dude, I got streamlined.
It was crazy. It was refis that got us through it.
Refis.
Right? So if somebody wasn't in foreclosure, the government came out, and I cannot remember the name of the program, but you were allowed to refinance anyone regardless of the loan to value. So they could be completely upside down.
Was that TARP?
I think it was maybe, oh gosh.
I think TARP was the money to give to the banks to keep them solvent. I got to remember, but.
Yeah, I'll have to look it up when we're out of here. But basically, I remember it somebody would owe $100,000 and their house would be worth 50, and you would still be able to refinance them to give them the lower rate, right?
Okay.
So there was no appraisals needed. You would just run it through the automated underwriting system, and as long as they had the credit and the income, that was it. So we survived on
But that's
refis.
smart.
It is smart. It's common sense.
Yeah.
Not a lot of that.
Not a lot of that. But as a bank, it's like, do I want to get no money or some money? Because it's going to be no money. You're going to be holding how many assets did the bank hold that they didn't want, getting 10 cents on the dollar versus someone that's saying, hey, man, I'm willing to make the payments. Let's work with me.
Yeah, because if not, it was short sale, short sale,
Yeah.
short sale. Every purchase I did was a short sale. We'd get a purchase contract, and now you're like 30 to 45 days we're closing. That, maybe we're closing in 6 months, maybe we're closing in 9 because you're waiting on the approval from the bank. So it was refis and short sales.
Man.
That was it.
When did you see, like, when do you think, 12, 13, when you started to dig out of there?
2012 is when it started to
2012.
become normal. I remember I had a good year. 2012, there was purchases, rates were low. We had a little refi dip again. That's when it kind of started to become normal. And that's when all the additional guidelines came out from Fannie and Freddie. Like, we're never going to have this problem. The Dodd-Frank bill.
Yeah.
That came out and kind of reset everything. That's when we got rid of the good faith estimate, got the loan estimate, kind of everything changed.
But don't you feel that we're kind of reverting back? It seems like, not to talk, we'll lead into what we just talked about in terms of like, but it seems to me that instead of staying that course, we're going somewhat backwards, or maybe it's backwards. I know this sounds odd, and I would love your opinion on this. It seems to be harder to get a loan the more, how do I say this? The more assets you have, the more successful you have, the better you are on paper. It seems harder to get a loan.
True. Like, for instance, jumbo loans. Jumbo loans, it's a hard underwrite, right? And jumbo loans, anything over 832, 750 for a loan amount, right? And they pick those people apart, right? Like, they're self-employed. They send self-employed people through the ringer. But yeah, I feel like we're going back because, we used to do those no-doc loans. Stated income, stated asset. This waitress, is making $100,000 and she got $100,000 in the bank, and you would write that in the application, and that's what would go. Now we have these DSCR loans, right? Which is debt service coverage ratio loans. So basically you can go and buy an investment property without showing any income. The only qualification is you need a credit score, and then the rental income has to meet or exceed the amount of the mortgage, taxes, insurance, the PITI.
So they don't really care. They're looking at it saying, hey, this piece of property is self-sufficient. We don't really care what the person has.
Yep. Got to put 20% down.
Okay.
Right? But yeah, they're not even asking for tax returns, pay stubs, not verified income.
I guess if you put 20% down and then the building is bankrolling, basically the bank's like, I'll just take your 20% and I have the asset and I'll just sell it.
It is, and it's a higher rate too, right? So they're offsetting that risk with the higher rate.
What's the rate difference on that?
Probably 1%, right? So if you're going to say at 30 years in the mid-6s today, I would say a DSCR loan is probably mid-7s. Now, the more money you put down, the better the rate you're going to get. You put 40 or 50% down, you're going to be in the high 6s. So it's not terrible.
No, and it gets you in the game.
Yep, for sure. And they'll put a lot of prepayment penalties on those, which are not common, right? They'll do like 1 to 3 years, depending on what rate you want. And it's the only type of loan that I know of that you can close in an LLC.
Oh, wow. Mm-hmm. Who holds the paper?
It's usually these banks.
The banks?
They're portfolio lenders, right?
Okay.
They're not getting sold off on the secondary market like a standard Fannie Freddie loan.
Do you guys do those loans?
All day long.
Okay, and then you guys hold the paper yourselves?
We will not hold the paper on those.
Okay.
Right? We will only hold the paper usually on Fannie, Freddie, FHA, VA. We'll service those loans.
How big is SLS?
Yeah, so SLS is part of CMG, right? That's my parent bank.
Okay.
They have over $100 billion in servicing, so they're big.
They're big.
Yeah, big. And we're privately held, which is nice. And the owner just bought 2 federally chartered banks out of Wisconsin. So it's going to be nice because I think he wants to compete with the big boys as Chase, Citi on those jumbo products.
Yeah, the jumbo from the big banks is tough, man. The rates are low.
They're buying the market. I mean, during COVID, it was the exact opposite. It was flip-flopped, right? We would destroy the banks on, jumbo loans. And now, which makes sense, you think like a big bank, why would you want to lose that deal? Because if that borrower walks out the door, they most likely might take their deposits out the door too, right? So a lot of these big banks, your Chase, your Citi, your Bank of America, if you have accounts with them or investment accounts with them, they'll drop their pants, so to speak. They'll give you a below market rate. They'll lose money on that deal because they don't want to lose your deposits. It's a good business model.
Yeah. I have a lot of friends that like when they're looking at stuff, and people that like I've reached out to you with, they're like, well, if I deposit X amount of dollars, they just want me to put 20 grand or 50 grand in a checking account and I can show it. And once I show it, then I'll get the rate.
Yeah.
And then he's like, and then maybe I'll pull it out. But what are the odds of people pulling it out? They're probably like, fuck it.
They're going to leave it. They're going to be lazy and leave it because it's there.
And they probably know the stats on that.
Yes. They're
stats.
like, oh yeah, move. A lot of the times I'll see like on the bigger loans, like move 250 grand over. And that can be part of your down payment. So if you're going out and buying a $1.5 million place, you're going to put down 20%. That's 300 grand. Well, you just move that over from your investment account, and all of a sudden you're a private client. Then you get qualified for that 1/4 point discount.
I know, but the service is terrible.
The service is terrible, and getting the loan closed is terrible. Yeah, I'll get a lot of clients that'll come back to me after 2 weeks and be like, okay, can you help me now? Because it fell apart at the big bank.
I had a good discussion with somebody yesterday. How do you guys as a profession I think that's one thing that people don't understand is the servicing end of it. And obviously, I know like, hey, listen, they're going to get my thoughts on XYZ on people, but how as an industry do you guys say, hey, you can go to Chase, you can go to B of A, but here's the difference with us?
Yeah, I think a lot of it's personal touch. Like anytime that borrower wants to talk, they're picking up the phone and they're calling me directly, right? You go to Chase one time, you're talking to 3 different people, and then you go back 2 years later to do a refi or do another purchase. You're not going back to that same person. You're getting passed around, right? So I think it's nice to have, one consistent voice throughout the process. And I always tell people, things always happen after closing. Guess what? Cook County, what happens? Taxes usually go up, right? So their payment's going to go up. They're going to do that escrow analysis. The payment's going to change. Usually, you might be talking to someone, overseas trying to figure out, hey, why is my payment going up by X amount? Well, you know what? Because we service a loan, you just call me. I have a back door into our servicing department. I'll be able to explain it to you, help you out with, kind of resetting that escrow account. I mean, there's little things like that where it's like, there's a value add there.
Yeah, there totally is. I just think there's got to be a way to communicate that versus, because I mean, like for me, when someone says, hey, I'm going to go to Chase or I'm going to go to B of A, or I'm going to go here. First and foremost, I say, listen, just so you know, if you bring a Chase pre-approval to like if there's multiple offers, like if I'm viewing offers and there's 4 offers or 5 offers and it's Chase, B of A, Brad Bowden, this, I mean, right off the bat, like you have an in.
For sure. And, I always say Chicago's a big, small city, especially when it comes to real estate.
Yeah.
Right? Like you kind of know most of the main players, right?
The main players.
And it's like, I don't know how many times I've gotten a call from a listing agent like, oh gosh, I saw your name across this and you know what? We're going with you because you've closed deals with us in the past.
Yeah.
Right? So I think it's a big deal. And, those big banks, your file gets lost, right? Like you won't get a call for 2 or 3 weeks and then it's right before closing. It's, oh, we need X, Y, and Z or, we can't get this condo done.
I don't think people understand that they don't start the file to like a week before closing.
Yeah, it's wild. And then, I just know that you'll talk to that initial person up front and then you're passed off down the line to different people. So, you're buying a home, it's a big deal. You want to feel like secure. You want to feel safe. You want to know that, someone's kind of holding your hand throughout the process. And then to talk to someone once and then get passed along to 3 other people on the team, I don't know, I'd be frustrated.
Not only that, but think of like in today's day, everything has to be without a mortgage contingency to get anything.
Yeah.
So I always tell people like, you want to call Rocket, and no offense to people who work for Rocket or this. I'm like, whatever you do, just understand that you have 5% you have 50,000. So my average sales is like, I think 1.2. So you're going to have $60,000 to $80,000 unprotected.
Yep.
And if you miss that close date, they could be like, fuck you, give me your money.
Yeah.
Now, it doesn't happen. They want to get the sale, and there's a whole other slew of legal stuff. But the simple fact of the matter is, do you want to put yourself in that position?
Yeah, it's tough. And all over
it's
maybe
really tough.
0.125 in rate.
Yes.
Right? Something so small. It's like, it's not going to move the needle that much, but it's going to be so much more stressful.
Yeah, and I have people that say, well, that's a cup of coffee or this or this. But then when it's all said and done, they're like, who was it? I sent someone to you and they went somewhere else, and it was an absolute disaster. And the morning of the closing, I said to him, I go, everything should be good as long as you got, like, I kind of washed my hands. I'm like, this is, if anything happens on the financing end, this is on you.
Yeah.
The morning of the closing, they had not even sent out the CD yet.
Oh, that gives me a panic attack right there.
And I don't know what kind of shenanigans they pulled. Like, they post-dated it for, like...
Oh, Jesus.
And I'm like, you didn't get any numbers or figures or anything? They're like, no. And it was some obscure online lending. And they had no mortgage contingency.
Nor do they know the Chicago market and like the nuances of it, or the Chicago tax stamp.
Or the
like,
taxes.
Oh gosh, like I'll say, like, oh, they, like right now where we, taxes are late in Cook County. Go figure, right? Again, so we're holding TI, like extra money for taxes. The title companies are.
Yeah.
And then you'll get a loan estimate from a lender out in California, and they don't have that listed on there. Then the borrower's like, well, why are you charging this? Well, it's not me charging. The title company's going to hold money to pay the tax bill when it comes out.
Do the California people?
They don't know it.
Yeah.
Well, and then all of a sudden your cash to close is 10 grand higher the day before closing, and you're going, oh my gosh, what happened?
Yeah. Or they always, like, the California banks will yell at me and be like, well, where's the taxes? I'm like, well, they're going to be X amount because we don't really know. We'll just take the percentage of. I'm like, no, it's not California. It
doesn't work like that.
Doesn't work like that here.
Yeah.
Or they'll call me up and be like, okay, where are you closing, and can you send me the escrow person's name? I'm like, no, we're a lawyer state.
Not how this works.
It's not how this works.
Yeah. A lot of states do not have attorneys. I mean, I'm licensed in multiple states. It's really just Chicago and Illinois that really has attorneys involved.
Do you know there's no title insurance in Florida?
It's weird down there. I'm licensed down there.
They have a ton of
fees,
fraud and shit.
They have tax stamps, doc stamp tax. It's like, but they don't have income tax, so they got to get their money somewhere.
Somehow, yeah. But I was talking to somebody in Florida. Is like, dude, the amount of people that buy land and then go to it, and then there's someone building on it because the land sold 2 or 3 times because there's no one like holding title.
And that's like one of the only states where they will always require a current survey. Here in Illinois, they'll always use an old survey. But out in Florida, every time you close a deal, you need a survey.
Well, it should be like that.
Yes, it should be.
I haven't had anybody allow for an old survey.
Yeah, I mean,
except for a condo building, but all homes.
Yeah, condo building.
All homes, they all want a current survey.
We just usually don't see
3 months.
Them. Yeah.
You probably.
We don't really see that side of it.
No, that just goes right to title, and they either.
But in Florida, it's like a requirement. It's an underwriting condition. Give me that new survey.
And then the underwriter looks at the survey.
They just want it in the file.
Yeah, they don't know what the hell they're doing.
Yeah, they're not. They don't know about easements or anything like that.
No. Tell me that one. This is really going to affect a lot of people. That one new requirement that's going to send HOAs much higher.
Yeah. So Fannie and Freddie just made some pretty big changes to condos, right? And everyone's hearing about condos and the Fannie Mae do not lend list. I'm sure you've heard of it, right? Where you just can't lend on a building until they get stuff fixed, right? So now with any condo building that's 10 units and under, there's no review. So that means no budget, no condo questionnaire. If there's litigation, we don't care. The only thing they want is the master policy of insurance. Now, any condo 11 units and over, they're going to do a full review on no matter what. So they're going to get the budget. They're going to get the decks and bylaws. They're going to get a condo questionnaire. But the big change that I think is really going to affect a lot of people in Chicago, because we have so many high rises and condo buildings 11 units and more, is, before in the budget, every year, the HOA needed to put 10% towards reserves. So let's just give an example. You have a condo building and they're bringing in $100,000 a year in reserve income. 10% or $10,000 a year has to be a line item that it's going towards the budget for reserves. Okay. Now, starting January 1st, 2027, it's going from 10 to 15%. So that means every single HOA in America that's 11 units and more has to redo their budget. And this is probably going to make up, HOA bills go higher for everyone.
Yeah.
And it's across the board. And if they don't have it, they're going to be on that do not lend list, and it's tough to lend in there.
Man, but has everyone, I'm just wondering if all the managed groups have to know this is coming on.
Yeah, they know it's coming on, and they usually do their budget approvals in the fall.
Yeah,
like
it's
September,
coming soon,
October,
September.
November. So they're all going to have to do it. So you better believe that, come the first of the year, all these people in the high rises and these bigger buildings are going to get, letter in the mail. Hey, your HOA dues are going up by X amount.
What is the biggest do not lend thing you see? Or do you just see them come over, or do you see what they're...
The most common thing is anything it repairs structural.
Structural.
Anything. You mentioned tuck pointing. You mentioned, on these high rises, fixing balconies. I mean, it's a hard stop. If they figure out that there's this current special assessment going on for anything structural, even if it's the garage, which to me didn't make sense because it's not even the actual units. It's like a separate garage. But anything structural, they'll just say, hey, until that work is complete, you're done.
You know what's really interesting? I was selling a church conversion, a condo, and they, on the minutes, like 2 years ago, they mentioned just not repairing, but just fixing up. There's 2 steps.
Just the mention of it.
2 steps going into the place.
Yep.
And the steps are from 1890.
Yeah.
And they're just worn out. So like, hey, do we want to redo these steps at some point? That was 2 years ago. They picked up on that on the minutes, and they're like, we're not funding this unless you fix the stairs or you get somebody over there that says the stairs are okay and they don't need to be fixed. Exactly
right. Give me from your written professional, like, hey, in writing, these are fine. They're sound structurally.
Yeah. But it was over
wild.
2 steps.
Yeah.
So that's crazy.
Yeah, that's the biggest thing. A little bit for litigation, but not so much.
Yeah. Okay. Before we get into the other things, because they kind of ranch into it, affordability. What are your thoughts on? I have a couple ideas in my head, and they kind of go into something we talked about beforehand. What do you think? How can we forget about Chicago, but how can we get more affordable housing everywhere? And I don't think the way they're tackling it is right, because the government, whatever they do, is wrong. But how we need, I don't think we need to suppress pricing. We need more supply. More supply,
110%. Right? I mentioned I'm licensed in some different states. Like down in Texas and Florida, they're building like crazy.
There's no red tape.
They probably have no shortage, right?
No, they don't.
I mean, there's listings sitting out there forever.
Yeah.
The problem here in Chicago is you don't have a lot of space, right? So whether that be in the burbs, somebody's got to start building.
Well, we can create space by easing zoning.
Yes. Yeah. A lot, like you said, a lot of government here, a lot of red tape here.
Yeah.
Right.
So I'm just wondering, in terms of when the government sits there and says, hey, we're going to create supply by creating more affordable units. I mean, how does that work considering somebody has to build those units? And no one goes into business for free. So how are you going to build units and have money be made, right? Because the people that buy these units, I don't think they want to work for a deficit either.
No.
I think if someone's saying, hey, I want to get an affordable unit, but where I work, it's $10 an hour, but I've agreed to work for $6. That's what these buyers are kind of saying to the builders. Hey, I want to do this. I want to do this. And builders, this will be on the pod I just with Vince. Vince just sold those 4 homes for $4.5 million in Wicker Park, record sales.
Wow.
Okay, so they were supposed to build 50 units there. And the builder's like, hey, I'll do 1 bedrooms, 2 bedrooms, 3 bedrooms. I'll do a really nice mix of different money.
Throughout.
And the alderman's like, well, no, it's got to be 30% affordable. The developer said, if I go 30% affordable, I lose money. Not that
that's your margin.
Yeah, not that I don't make money, I actually lose money.
Yep.
And the alderman's like, that's the rules. I was like, well, okay then. So instead of building 50 units, they built 4 $4.5 million homes and sold them all like this.
Which just makes the problem worse, right? Because you would have had 50 units.
50 units.
And if you were to even do a third of those, okay, fine.
And Vince is like, we didn't want to build these homes.
It's wild.
It's like, that's the only thing we could do with a massive tract of land. Each house has 72 feet of frontage.
Oh, wow. So it's bigger than a standard city lot.
3 almost. So 72, and the depth was like 180. You could build a huge building, and the best part is it was next to it was close to an L stop, so they could have made it with no parking. They could have made it one of those things where you have to use public trans. And the city was like, the alderman was like, no.
I did not know about this. That's wild.
So it's happened to me too. It's happened to investors that I have in buildings that we've been in, and it's like the only way to really get something affordable and to provide lower prices is you have to increase the supply because the demand is there.
Yeah, demand's not going away, especially here.
Yeah. Right. Well, you were saying, talk about you said we're the same rate from a year ago.
So, right before I was coming here, I was just kind of looking at historical trend in mortgage rates because, rates have gone up because of the Iran war, right? So we're probably, I think when I left the office today, the average 30-year fix was like 6.8. It is the exact same as it was in July of 25, right? Yet mortgage applications are up 6%. Right after COVID, I kept hearing people, we're going to wait for rates to drop.
How'd that work out for them?
Yeah, right? The whole phrase of, what is it, marry the house, date the rate? Like, rates haven't gone anywhere.
No.
Right? And I don't think they're really going to go anywhere, right?
Before we went over to Iran, we were like at 5.75.
I think selling high fives in February, March.
That's going to be the lowest they get.
And I think that'll send the market into a tizzy. People start seeing fives. It's like, wow, this is unbelievable. And it is unbelievable, right? Because I remember when I first got in the business in 2005, the first loan I ever sold was like 6.8. That's normal.
Yeah, my first loan was 9.75. My mom's like, that's really low.
Yeah, because they were in the teens, right?
Yeah, they were in the teens.
You're like, you're under double digits? Oh, this is fantastic, right?
Yeah.
So I think people are just getting used to the fact that these rates are kind of here to stay. We might see a little bit of movement, half a point down. When this Iran war finishes, I think you'll see what rates come down, for sure.
But it's going to completely be, that rate's going to be completely offset by the amount of buyers and the push up again.
Exactly. So that's why, I tell people, don't worry as much about the rate. I mean, if you're okay with the payment, what are you waiting for?
Yeah.
What's going to happen is, you saw this spring, it was bananas. It was one of the craziest springs I had.
I've never seen anything like January to April was bananas, dude.
It was nuts. And I felt bad for the first time home buyers because you have all the parents coming in helping the kids out. Hey, we're going to do cash with mortgage allowed.
Yeah.
Right?
Everyone's cutting out a bank statement.
Yep. And like you said earlier, no contingencies.
None.
We're going to buy the place as is. We don't care what happened. Boom, let's go.
And I don't, we're going to have that again.
We are 110%. And that's what I'm saying. If rates go down into the high fives and it's next spring, I can't imagine.
Somebody asks clients, when I meet with someone for the first time, where do you think rates are going? I'm like, well, you're buying. I go, you want them to go to 10.
Yeah.
And they look at me like I'm crazy. I go, dude, you want to battle 20 people and pay $100,000 over, or do you want to just walk in and get a little bit of a discount?
Yeah, and listen, you always can refinance too, right?
Yeah.
But that's never a guarantee, right?
No.
So you can't bank on that. But yeah, you're going to have so much more competition. I think, I read a stat, earlier today too before I came that, 29% of people that wanted to buy a home last year actually did it out of 100%. It's only 29% out of 100, were able to actually buy a home. So there's still pent up demand. There's people sitting on the sideline.
I mean, I don't know how, and it'd be interesting because you work with, all types of realtors. Mm-hmm. How are young realtors and people that are just getting into the business or don't have a reputation? I want to say, let's say I did 40 sales in that time, which is probably about right, 40 buys.
Yep.
Out of those 40, 30 of them were personal, friends of mine. And that's the only reason I got this place is where I was like, man, you got to help me out.
Exactly.
Literally.
It's nuts.
So how do those people, how are they surviving?
That and they can't go over that much in ask price, these younger buyers. But yeah, these younger agents, I have a guy who works for me. He's my production assistant. He interned with me for 2 years in college, and he's been with me now for 2.5 years, right? And I just flat out told him, it's going to take you 3 to 4 years for you to make money in this business.
Yeah.
Do not think you're going to come into this business and it's all rainbows and unicorns. You're going to have to hustle. But it's tough. You got to establish relationships and, kind of work your network, like you said, your family, your friends, but it's got to be tough for the younger generation.
Especially with the changes they made with this buyer's agreement required. You're walking up to somebody, what are you, why should I?
Yeah. What's your value?
What's your value?
Yeah. What have you sold? Can you show me your portfolio?
Yeah, what's your value? What are you going to do that no one else can do?
It's got to be someone that you know.
Yeah.
Or else they're not giving you a shot.
They're not giving you a shot.
Because it's you going up against, for instance, you or Sophia, and then somebody younger.
They're fucked.
They're going to you.
Yeah.
I would too.
It was interesting. We were interviewing, Sophia and I were interviewing for a listing, and the first thing they said to me is, what is your buy-sell spread? And I said, for 20 years, I've been 60% sell, 40% buy. This is the first year ever that I was 60% buy.
Really?
Ever. The first year I've been over 50+ 0.1.
Yeah. Well, I mean, listings are just like hard to come by. You get a listing, it's like gold.
These renters that are just flooding the market. Like, when you meet with the renter that's new to the market, do you sit there and be like, hey, you're paying this in rent? Have you thought about the tax implications and all this stuff here? Like, what do you tell those people?
Yeah, all the time. And like, here in Chicago, it's the norm sometimes for these, people to be paying $4,000 and $5,000 a month in rent, which is just wild. Cause I always tell people, I'm like, you're paying someone else's mortgage.
Yeah.
Right. Like you can scrape together 3 to 5% down and you could be probably paying $3,500 or even $4,000 the same and you own the place.
Yeah.
And then you don't have to move every year. Cause let's face it, moving's not cheap either.
No. And you're legged into that price.
Yeah.
You're not going to be going through a 30% rental increase.
Yeah. And rents just continue to go up.
It's interesting. Like you always hear, like I always like when I'm scrolling, some guy will be like, oh, buying is this, you should be renting, blah, blah, blah. And all they talk about is, you got to rent. I mean, when you buy, you have HOAs, you have taxes. I'm like, okay. And they're like, and then this, but they never say, oh, by the way, in 10 years, the value of your property is up 30%. They don't tell you that every payment is buying down your note.
Yeah, you're paying it down.
They don't tell you write off all the interest. It's just interesting to me.
It's wild.
Yeah, and then
the property taxes right now.
Yeah. And that cap is gone. Yeah. So like I read the comments and I'm like, man, these people are so fucking misinformed.
There's a lot of uneducated people about it, right?
Yeah.
So
and they're learning from TikTok and IG, and it's like, man, this is not how it is.
No, TikTok and IG. Like I always hear you brought it up earlier. The assumable loans. It was like this fad. Like I don't know when rates were high right after COVID. Oh, you know what? You can just assume someone's loan. No. There's hardly any loans that are assumable out there. It's just not.
And that's point 2. How much inventory would we get if why is the government all sitting here? We need Democrats, Republicans, independents. I don't care who you are. They're all sitting here saying, we need affordable housing, we need affordable housing, we need affordable housing. You want affordable housing? Let fucking mortgages be assumable.
Yes, 110%.
I mean, there are really easy fixes to all this. All the R3 should be R4. Build as many multi-units as you want on an R4. Keep the FAR. Get rid of the R3 and the R2, which the ultimate only down zone because people that have a ton of money tell them the down zone so they can get more money to be reelected. And just make everything assumable.
Yeah. I mean, it's wild. How many boomers I'll talk to, and they want to move. They want to downsize.
I want to downsize.
They want to downsize, but it's going to cost them more because the rate is double what it was in COVID, right? And that's what everyone's got. And then the places went up in value, right? If you went and let that be assumable, you know how many boomers would move out of their house?
Dude, there'd be so much inventory.
There'd be so much inventory.
And pricing. Listen, not to hurt people that own properties, but pricing would just drop. I'm not saying we all have 50% equity now. If you bought before,
correct. If you bought in 2020, 21, 22,
you're just rolling.
You're golden.
Yeah. So okay, you're not up 50% now. Now you're up 30. But I mean, because Nikki and I are like, okay, Lee's leaving the house. She goes, in 3 years, Will's gone. She's like, we don't need this big of a house. And I said, let me show you something.
Here's what it costs.
I pulled up a house in Roscoe Village. I'm like, you want to go back to Hamlin so James can just walk to Hamlin?
Yep.
It's fine. Here's a house that's half the size of our house, but a third less expensive. However, is almost 3 times the price on a monthly. And she looked at it and I'm like, dude,
we're not moving.
Welcome to rates.
Yeah. This is where we're at. But you're right.
All that, I mean, I would sell my house and buy a smaller house tomorrow.
I think a lot of people would. And it's not a hard fix, I feel like.
No. But the banks don't want it.
The banks don't want it because they're making money.
And they don't want to. Do you think it's because they don't want to? They want to. If you're buying something, they want to restart the amortization schedule.
110%.
But let's restart it at that rate then.
Yeah. Yeah, because then you get
because that's what they want.
They want the portable mortgage, but that's never going to happen. I saw that going around on TikTok and IG, a portable mortgage.
No,
you can't take a mortgage from one to the next.
Because
it's not feasible.
No, because you're leaning up on that asset. That makes no fucking sense.
Yeah, and that was all over Instagram too, and I'm like, oh my gosh,
that's the most ridiculous thing I've ever heard. But to say, hey, you can assume this rate. However, you're not getting them, you're not getting 10 years into the loan. We're going to reset the loan like a refi.
Yep.
We're going to reset the loan and you can go this way. Even if they did it like VA does, where you could only, you have to assume that debt.
Yep.
You can't add more debt.
Correct.
Even that would help.
Yeah, anything. Because there's so many people that they're stuck.
Yeah.
Stuck.
The VA thing, the first time I ever dealt with the VA, assuming a VA loan was this year, and that was interesting.
Yeah, it's a different process. Wild to me that I didn't used to know until I actually started reading the guidelines years and years ago is you don't even need to be a veteran to assume that loan.
No, so it's a veteran to buy it, and then as it's passed on, it doesn't matter.
Doesn't matter, right?
So why doesn't everybody get VA loans?
Exactly, because VA loans aren't as common, especially around here. We don't have a big military community, right?
But like, if anyone can assume it, now once you assume that loan, the veteran can never get another one. Is that not true?
Not true. You have something called VA entitlement, right? So there's like a calculation in a spreadsheet you do, but you can have 2 VA loans at once, but you can't do no money down. So the big thing with VA loans is you can do 0% down. Okay. Below market rates, fantastic. No mortgage insurance. They can go buy another place, but they got to put some money down. It usually shakes out to about 5 or 10%. Okay, great. That's not a big deal.
No.
Most other people are putting 5 to 10% down anyways. That's probably the average right now.
Yeah. So it just seems like it seems to me everything that's a no-brainer is never done. And like, let's do stuff that creates other issues.
It's frustrating.
It is. And it's just like, did you see some of the rent? Like, you want to talk about rents going up? Did you see some of the rental stuff that Bozo wants to do in Chicago?
Oh, no. I heard about it. The tenant stuff where they have they already have all the rights to begin with, but.
If you re-rent to someone else, you have to pay for them to move.
What? I did not see that.
Yeah.
Oh my gosh. Did it pass?
No, I mean, this stuff is
just pure, like.
It's pure. It's just
conjecture.
Yeah, it's podium politics. Yeah. It's like the most, it's more ridiculous than anything that came out of Madami's mouth in terms of housing. I mean, he said more ridiculous stuff, but like, it's like, guys, this does not work. All it does is stop investment into real estate, and that's the one thing you don't want.
It's what we need. We need more supply. We need more people to be able to do it. Like you said earlier, if you build something, you got to be able to make some money on it.
Yeah, I went to the forum, and Jim Letcher was there, JDL, and a couple other big guys there, and they were like, we need supply, and they're like, the problem is that, and this is not on the smaller commercial side, but Chicago has been blacklisted. So we've been redlined from banks because so everything that Jim does is not through banks. All these guys,
private.
It's all PE. Mm-hmm. It's all private equity. And it has to be big enough that private equity will get involved.
Yeah, because they don't want something small. No. They're not going to do a single family home and a single family home.
One Chicago is private equity.
Oh.
The 78 is private equity.
Okay.
The Foundry Park, private equity.
Did they say why? Just because of the red tape and all the bureaucracy?
Taxes.
There you go.
Literally, the property taxes, they can't underwrite. They have no idea what's happening with the property taxes. And they also, Illinois got, and I don't know what, the governor's like, I have the heart, I've done this. We're just above junk bond. We're BB minus.
Yeah.
BBB minus.
Look at the Chicago Bears. They can't figure it out either with the state, right? With the taxes. It's like, come on.
And it was interesting. He was like, one of the governor's things was, I'm not going to raise taxes and tolls just for the Bears. So the Bears decide, okay, we're leaving. And then a week later, he passes 50
new
tax
taxes.
hikes and he jacks up the toll tax.
Yeah, the tolls are out of control.
The tolls tax is supposed to be done in 1977, by the way. That was written. Oh. And then the state legislators removed it.
Oh, jeez.
The toll tax was only to pay for those toll roads, and that was supposed to be removed.
Now it's just paying for everything else.
Now it's just paying for God knows what it's paying for.
Gotta love Illinois.
Oh, my Lord. Where do you see, so we both agree that rates are what they are. You may see a little bit here or there.
Yeah, we may get some relief.
What do you see in terms of other products that, I got to silence this. My bad. Hold up.
No worries.
I always silence it and I forgot. And you know what these people are? These are all
spam.
All spam. And they're all, you know what they're all trying to do? They're all trying to get me to buy leads. And it's the same person. And you know how they start off? It's very interesting. They go, we talked last week. That's how they start off. And I'm like, no, we didn't. And
they're like, I have a good memory.
They're like, yeah, we did. I'm like, are you selling leads? They're like, well, yes. I go, then we didn't talk because I don't buy leads.
Got to get you on the do not call list.
I'm on it.
Oh, and they still can get it?
Yeah.
Oh, geez.
And they're really good now because they use 312s and 708s
yes,
and
they use local numbers. I noticed that.
with people's names.
Yes. Yeah, because I get that when they call my phone, it says spam, but it's a local number. So I'm like, oh, well, maybe it's a new client.
You got to answer.
Got to answer.
And then if there's a 5-second pause, hang up.
Yep.
Because that means that you got robo-dialed, and then they're directing you to someone in Bangladesh.
Great. Just what I need.
Yeah. So you could buy leads. So what like you said, let's talk about the product that you were talking about in terms of the buy sell.
Oh, like if somebody needs to buy and they can't.
Yeah. So the biggest problem people are having now is obviously no one will accept a contract with a sales contingency. It's going to be 6 years till that's accepted.
Yeah, that's
again.
not happening
For a long time.
Yeah.
So tell me about what workaround you guys have.
Yeah, sure. So, as you just said, it's very, very difficult to get an offer accepted with the home sale contingency, right? So, a lot of people need the money from the sale of their home to put down the new home. But I might say, hey, listen, if you can put 5% down, which is the minimum when you're not a first-time home buyer, let's go see if we can qualify. Yes, you're going to have mortgage insurance, but guess what's going to happen? You're going to sell your place a month after we close, or probably even before that with how competitive the market is. Then you're sitting on this pile of cash. Maybe they have $100,000 or $200,000 from the sale of the home. Okay, since we service the loan, we're in control from start to finish, right? So after the first payment, they're allowed to do something called a recast, which is basically we take your money, we'll re-amortize your payment, get rid of your mortgage insurance, and it's like nothing ever happened.
So it's not a bridge.
It's not a bridge. Nope.
What is the main difference between a bridge and what you just said and a recast?
So a bridge loan is like when you take a loan out against your property and you're putting a bigger down payment on the new place, right? I'm not the biggest fan of bridge loans. Because,
so you're taking the equity out.
Yes, you're taking the equity out of your current property and you're paying fees on it, like an absorbent amount of fees and a really high interest rate, right? For maybe only a couple of months, right? Well, instead of taking a bridge loan out, let's just do the minimum down. Okay, great. You go buy the new house. You pay one payment at that higher payment. So with the mortgage insurance and the higher principal and interest, and then we'll go take your money, we'll re-amortize it, lower your payment, drop the PMI, call it a day.
When you qualify people on that, are you like you have to sell the house at X amount of dollars to make it work?
No,
or is
you're
that
still qualifying. You're still qualifying for both places at once. Yeah.
So your DTIs have to.
You got to mesh with both properties at once, right? Sometimes it works, sometimes it doesn't. A lot of times we'll get a co-signer involved, mom, dad, something like that. But yeah, you got to qualify for both places at once.
I've heard sometimes people will refinance to like a daily rate on their regular house to drop that payment.
Oh, I have not heard of that.
Yeah.
That's smart though.
Yeah. So you refi that to basically...
You almost refi it into a HELOC, so then the monthly payment's interest only, just so you qualify.
Almost cuts half, and then your DTIs kind of match.
Yep. I haven't seen that. That's a good idea though too. Have you seen it? You're like, hey, I've been doing this a while.
Yeah, this had to be 10 years ago, and someone was like, they were like, okay, we'll do this, and then I remember the buyer telling me, okay, I've got to, he's like, I'm refinancing the house. I'm like, really? He's like, yeah, you know why? I had to take it off the market.
Yeah, you can't refi it when it's on the market.
That's what it was. So I took the house off the market. He went from a 30-year fixed to basically like LIBOR.
Yeah, like an ARM.
Like a total one year, like that was it. It may even been a floating daily rate. I mean, it was just, but his payment dropped so much, and then all of a sudden the DTIs worked.
He's able to qualify.
He's all able to qualify.
That's another thing that's been weird. During COVID and before COVID, we sold a lot of ARMs, a ton of ARMs, because there was a big spread, right? There might be at least a half a point lower. These days, it's gone. If you're doing a conventional loan, I have people always ask me, hey, should I do an ARM? No. I mean, the ARMs are pricing out the same or worse. The only time we're selling ARMs these days is on jumbo loans.
Just what's the spread on the jumbo?
I mean, maybe 0.25%.
Then why?
It's not much, right? And that's why I always tell people, I'm like, okay, you're going to save an extra, $100 a month. Is that going to change your life? Because then that rate's only fixed for 7 years or 5 years or whatever the term may be, right?
Do you know why it happens? It's called an inverted curve.
Yes, yes, and it's been like that for a while now.
A while.
Yeah.
The investors are so scared of the next 3 years more than they're scared of 30 years from now. They would rather loan you money for 30 years in the future than the next 3 years.
Yeah, they're worried.
They're worried.
Conservative. They don't want to get caught with like last time.
Yeah. Inverted curves are bizarre.
Yeah.
It would happen when I was a trader, the curve would invert normally during wartime.
Yeah.
I remember when Bush Sr. went into Kuwait, it inverted. And then when Junior went in, it inverted, and then it went back to the bell.
Went back. Now it's just stuck.
Just stuck. It's been there for like 3-4 years.
Yeah, which is just wild.
Because of COVID.
Yeah, because of COVID.
Yeah, and it won't go back.
And now our country's in so much debt that I just don't see it going back.
Yeah, when you're at like 40 trillion.
And it just keeps getting worse every day.
It just keeps getting worse.
And that's the other thing that's probably going to not help rates come down in the future.
I was wondering if you wanted to get into that. I was actually in the shower yesterday, and I'm like, do we get into the fact that rates won't go down because we spend 7.5 trillion and we bring in 4?
You know, case in point, I was on the phone with the borrower yesterday, and I gave her a pre-approval letter, and she's going to put an offer in, and you know, she's like, "What's the payment?" I was like, "Oh, it's a little over 4,000." She's like, "I really wanted to get the 3,500. What rate would it take?" And I'm like, "Okay," and I put it in there, and I'm like, "Probably sub 5." I'm like, and I just don't see us getting there at all. Like, it's just not going to happen. Like you said, maybe high fives, but yeah, we have a debt problem, and you know, mortgage rates follow the 10-year treasury, right? I mean, it's pretty closely correlated if you look at a graph, right? Yeah. Nobody wants our debt when we are just printing money like it's left and right.
I know. I want to say like 20 or 30% of my podcasts always end up going into the fact that we're in so much debt, and that's the main problem.
It is. It is the main problem. I mean, yes, is the Iran war driving rates up right now? It sure is, right? It's inflationary. Gas prices go up, oil prices go up.
Yeah, but think about it. The Iran war, they're saying that it's because of oil. We only use 2% of the oil from Iran. And we're a net exporter.
Exactly.
So that's just bullshit. You want to know price gouging? That's price gouging. How can a war break out at 9 p.m. and then I see a guy on a ladder at 8 a.m. changing gas prices? Did the fucking gas in the ground get more expensive?
Did not change that quickly.
No.
It takes time to cycle through. But yes, it's price gouging. Oh, you even heard Trump stop price gouging gas right now. It should be coming down.
Yeah.
It's not.
Well, you know what a lot happened too when gas prices started to nosedive after Biden left, and gas prices nosediving. All the government, I mean, I can't say all. I know for California for sure, in Illinois, they just increased the tax.
Yeah.
So like when that spread came down, they increased the tax. So when the gas prices came back up, you now have double the tax. Plus, my favorite thing, and this will be my favorite thing that I love when I see people talking about is like, oh, gas prices in 2020 were $4. Now they're $4.20. You know, gas prices have gone up. No, they haven't. Gas prices have gone up to a person that doesn't think, but to someone that understands that we've lost 35 to 40% of what the dollar is worth. $4.20 in 2026 is less than $3 a gallon in 2020.
Correct.
So you're incorrect. Learn your math.
Yep. It's right. I mean, it's worth less.
It's not that. It's inflation.
Your dollar's not going as far.
Yeah. So they count, you know, I was talking about lowering rates.
Yep.
We bring in $4 trillion in taxes. We spend $7 trillion. And they know for sure now that we have about 1.2 trillion in waste. Like the Learning Center and all this other stuff, right?
Nick Shirley's all on it.
Yeah. So think about the fact that we're losing 1 trillion in just tax money that's being fraudulently taken by groups and by people. Mm-hmm. I mean, if you everyone was like, I can't believe that they're doing this or doing this. I'm like, listen, do you understand? The less we spend, the cheaper everything's going to get.
Yeah.
And rates will follow. Yeah.
It's like economics.
It's like, no, this is like. They passed a law that no one can investigate fraud, the Shirley Act.
That was in California. I saw that. It's like, how bad is that?
How bad is and then Gavin Newsom signed a law that you could not audit the homeless money, the $26 billion.
It's just wild. The corruption is just
You're going to pass something rampant that we can't know? And then they were talking about there's a ton of other state governments where you can go online and they have itemized every single dollar that the government spends for their state. Like, hey, this is our budget. Here's where every line item goes. And they made that illegal in California.
It's just crazy.
It's bananas.
Yeah. And
they're wondering why they're like, oh, the cost of living, this. Like, the cost of living has to do with, it's not just about the rate. You got to say, hey, listen, this is your property tax.
Yeah. HOA dues, insurance. It all adds up.
All adds up.
Yeah. You got to think about the whole thing.
And it's just like, you have unstoppable property tax. It keeps going up. It's
every year. Nor can we come out with a tax bill on time here, too.
That's nuts.
You know?
What were I kind of read some of the excuses, like it was
something about the technology change.
upgrade.
Well, that was the excuse last year, but it's the same excuse this year.
Is that what they used last year?
And it's the same. I mean, I'm on the Cook County website every day pulling tax bills for every time we get a property. It's the same website. It's the same technology. I don't know what changed behind the scenes.
But can't you find the multiplier now? Can't you know what the taxes are?
Yeah, but there's like a millage rate, what we use for new construction, but it's never accurate. I mean, like Cook County will give us this millage rate, which is based, you use that to base what the taxes are going to be, but it's always way too high.
What about, what are banks, like when you're doing new construction?
Yep.
What are banks asking for a TI or for like, hey, this is what we want in reserves? Like, what does that look like? You're buying $1 million property in Lincoln Park, if that even exists anymore.
Yep.
And, and they're like, and you go to the bank, you go to you and say, hey, this is what we have to run for taxes.
Yeah. So we have a calculation. It's called the millage rate. The city comes out and gives us, hey, okay, here's the tax rate for this area of the city with this purchase price. But it always comes in like 3% of the purchase price.
So each amount of the area, get into that.
Like south side of Chicago and the north side of Chicago has different millage rates.
Okay.
Right? So, up here on the north side.
Is that a multiplier?
Yes, it's a multiplier. And so up here, on the north side, it's obviously going to be higher, right? But it seems like general rule of thumb to me is it's like 1.75 to 2% of purchase price is usually your tax bill, right?
North and south or just north?
Just north.
But here's my question for you. If the values are different, why wouldn't the multiplier be the same and just be affected by the value of the property? Why would you want to also change the multiplier?
I think a lot of it may be school districts, like for instance, Oak Park. Right? Like
now we're out of the city.
Now we're out of the city. Yeah,
Oak Park's insane.
Yeah, insane property taxes.
Yes.
Anytime somebody says that, I'm like, oh gosh,
good luck.
What are your taxes going to be?
Yeah.
But yeah, I mean, there's no rhyme or reason here. I feel like it's like,
why does Oak Park have such high taxes?
I always hear because of the schools. But are they that great of schools?
No.
Exactly.
No one says I'm moving to Oak Park for the schools. I'm so sorry for Oak Park people.
Yes, but
I've been doing this 22 years. I've never heard that.
Yeah.
I heard I'm moving to Northfield and Glenview and, I'll go down south to Marist or something. Like, I don't
know why they're so high, but it's like they're the highest around.
Yeah, they're crazy.
By far.
And River Forest is crazy.
Yeah. I mean, it's just weird. You go down the street, you'll have one house at $10,000 and the next house at $14,000 in taxes, and they're the same house. Why is it different? Because one person contested them? I don't know. It's a lot of corruption here, I feel like.
How much money do you think tax lawyers that fight taxes pay people to make sure they never find a solution?
Oh, probably a good amount, for sure. For sure. Because they want to make it convoluted. We don't want to understand it.
I mean,
it's nuts.
It's nuts. I got a tax bill for $80,000 on a building that I own, and I had just bought it, and I was just like, I just sent a letter in, and they're like, "Oh, you're a real estate agent, so you knew, you had knowledge and no one else had." I'm like, "No, dude, here's the price, and it's been on the market for 3 years, blah blah blah." I hired a tax attorney, really good one, but he knows everybody. I went from $80,000 to $37,000.
Oh my god. It's who you know.
But I still had to pay him. I still had to pay him 1/3 of $33,000.
Yeah, which is worth it, right? But why'd you have to do that in the first place?
Why did I do it in the first place?
Yeah, corruption once again.
I mean, and Maria Pappas is not a bad person, but I don't think she deals with that. That's the other guy who I think they're going to can. The assessor.
Oh,
the old guy Barrios was a criminal.
Yeah, and then like you asked, like, what do we tell people when they're buying a new construction home? Well, here in Chicago, it's kind of nice. You're not going to have a tax bill for 2 years.
Yeah.
Right? Like somebody's
But then they get you.
They'll come around for 1 full year. But like if someone's buying a new construction single family home and they're closing this month, hey, when can I expect my first tax bill? Probably, August of 28.
Is there a time of the month that's best to close for closing costs, where it's more hidden in the loan versus out of pocket?
I get that a lot, right? So, let's just say you close the 15th of the month. We're going to hold 15 days of interest until the end of the month, right? And then whenever you close on a mortgage, you skip the first month's payment because a mortgage is paid in arrears. So you close July 15th, your first payment's not going to be until September 1st, right? So yeah, you're going to pay a little bit more at the closing table in interest because you're closing in the middle of the month, as opposed to if you do close on the 28th, the 29th, the 30th, we're only holding 1 or 2 days of interest, but your first mortgage payment is going to be sooner, right?
So could you close like on the 3rd and get like a closing cost credit?
You could. They allow you to go
2 months.
They allow you to go up to the 10th, basically, right? And you can do like an interest credit. But yeah, if you close, let's just say August 3rd, your first payment wouldn't be till October. So the Fannie Freddie rule is your note date, basically your first payment date and your note date cannot be more than 60 days apart.
Okay.
Right? So a lot of the times people are like, hey, moving's not cheap. I'm coming in. What's the earliest day I can close in August and not have a payment until October? It's usually the 3rd. So I just put in a little day calculator, figure out 60 days. It cannot exceed 60 days.
All right. I always said you wanted to, if you're getting a credit at closing and you want to kind of finance that first month, the best way to do it is the start of the month, the 3rd or the 4th.
Yeah, you're right.
What other little nuggets do you have that are savings? Cost savings.
Yeah, I mean, listen, if you can close quick, you're going to get a better rate, right? Like, we have something in our bank, it's a 21-day lock, right?
Okay.
It's going to be probably an eighth lower than the 30-day lock. And a lot of sellers right now want to close quick.
Yeah.
Right? So if you can do a quick close and you're ready, you're going to get a little bit better rate.
Is 21 days, anything earlier than that, it's no difference?
We have a 10-day too. And then it's going to be another eighth off of that. So if we lock on a 10-day, you're going to get a quarter point lower than a 30-day lock.
So can you go under contract and you feel like that rates are going to be stable and you're like, hey, I'm closing in 20 days and then lock 9 days? Or does it have to be when you go under contract?
You do not have to lock. It's up to you. The only time you have to lock is at least 3 days before closing because we have to send that closing disclosure.
That's CD, yeah.
And then everything's got to be in. But yeah, I mean, listen, with it being these days, I'm not a fan of floating, right? Because it's just been so volatile.
Yeah.
Trump opens his mouth, market goes up, and we're a quarter point in a week, right?
Yeah.
So I always tell people to lock because we'll always give them an option to float down, right? Now, what does that mean? It basically means that, okay, we have a 30-day close. I lock you in at 6.5. And in 2 weeks from now, Iran war's over, and all of a sudden rates come down. We'll allow you to float the rate down before closing one time for free, right? Now, it usually needs to move like a pretty good clip. It can't just move 0.125. It's got to usually move anywhere from like 1/4 to 0.5%. Right?
Okay.
So we're going to protect you either way. But yeah, I'll have some people that just want to roll the dice, right? They're gamblers. Hey, you know what? I think rates are going lower. Let's wait and see what happens for a couple of days. Sometimes it works out. Sometimes it doesn't, right?
Yeah, I mean, you go the wrong way 3 times faster than you go the right way.
Oh my gosh. Yeah, I mean, like, case in point, we had a terrible week in the market last week for rates, at least, for mortgage rates, right? We had a huge drop. It took us 3 days to get back what we lost in one day, and that's usually the case.
Yeah.
And the banks never want to give it back all right away. It's much slower to get it back than they take it away.
Always.
So they pull the rug out quick.
Yeah.
Right? Like, oh, got price change. You're like, oh, gosh.
Yeah. I used to say that when I traded, I lose money 3 times faster than I make it.
110%.
And the market, now it's the reverse. The market drops, and this is historical. The market drops, the stock market drops 3 times faster than it goes up. Mm-hmm. So it rockets down, and
it takes time to go back up. The little candlestick charts going slow.
Because people want to take profits where people literally just puke.
Pull the rug.
Yeah.
Boom.
It's like everything like that.
Everything like that. It's frustrating.
It is.
Because you're like, oh gosh, we were making progress on rates and then they're back up.
Yeah.
First time homebuyers are so sensitive about rates. And it's like, look at the payment. We'll worry about the rate later. Look at the payment. Are you comfortable with the payment?
But most of I will tell you, before we wrap up, the reason I had so many buyers this year is because the rental market, like I had people that had 2 bedrooms that were paying $7,000 for 1,100 square feet in River North. I'm like, that's fucking nuts.
You should buy, and it's probably going to be cheaper.
And most of these people are finance people. And you know what happens? Everyone's like, I'm just going to rent and then get my feet wet. And then you get complacent.
Yep.
And then they slowly jack you. Like I love like the rental people are like, oh, if you rent now, it's a half month free. But the lease renews. This is what they do. The lease renews December 31st. Who the fuck is going to move in
Nobody
December?
in the middle of winter.
No one.
Nobody. And time is money, right? And so as you know, the longer you hold something in real estate, the more it's going to appreciate. And in Chicago, I mean, we've been pretty steady at it. You probably know more than me. I mean, what are we averaging over the last 5 or 10 years? Probably, COVID's kind of skewed that a little bit. But
yeah, I mean, the last 3 years we've been number one. We're at like a steady 6 to 7% every year.
I mean, you do the math on that over 5 years. It's like, wow.
Well, it's leveraged.
Yeah.
Which is nuts. Like I have people like I had one buyer And he was like, this is actually the guy that was shopping people for like an eighth of a point.
Yep.
And he's like, it's like, well, I don't, he's like, I'm in a rental. It's like, I don't really want to dip into my stocks, this and this and this. And I was like, listen, man, I said, I have a decent portfolio in stocks and I've done a ton in real estate. I go, I'm going to tell you right now, my stock portfolio is like for the money that I'm just like, okay, I don't care. Not going to care, but like, you don't make money there. You make money here.
In real estate, 110%.
I'm like, if the stock goes up $1, I make $1. If real estate goes up 1%, $1 just made me 10.
Yeah.
I'm like, it's on margin. I'm like, you can't, and you have utility. I'm like, it just can't, because my financial advisor is always like, oh, let's do this. I'm like, man, I go, I get it. Let me do what I do.
This is what I do, though,
and
right?
then I'll give you portions of what happens.
Yes, I'll give you little chunks of it.
I'll give you this, when it goes through.
But I'm going to go buy another building.
Yeah, I mean, because it doesn't even, and all the laws are written by people that own real estate. Yeah. Everyone in Congress is a gazillionaire. They're writing laws for gazillionaires.
Yes.
And they all own real estate. So all the real estate,
1031 exchange to the next place, roll it over, boom.
And just gradually you die.
You sell stock, you're paying, the capital gains on that immediately.
Yeah. And how about the fact now they want to tax people on assets?
Like that's wild.
Your portfolio.
You got to be
on
kidding me.
Unrealized gains.
Which is like, because it could go down the next day, and wait, I just paid tax on it. But it went down. No sense.
I just don't know if those people know that's why we fought the British. Like, this whole country was based on private property ownership. Like, like this, like you're starting to go places where it's insane.
Yeah, you're going a little too far. Get the money elsewhere, or just cut the spending.
Yeah, or just cut the fraud.
Yeah, cut the fraud.
Cut the learning center.
That's the Leering Center.
Leering Center.
Come on, get it right.
That's the best.
I'm gonna buy you a shirt. Leering
Dude,
Center.
that's the best. Any final thoughts? What do you
No, I appreciate you having me on here. It's been a good time.
We talked about, forget about the average buyers. We know that.
Yep.
The boomers, right?
Oh, the boomers. Oh, yeah. What did we say? So boomers hold 34% of all real estate. Okay. Boomers made up 42% of buyers so far this year and 53% of sellers.
What do you see, though? I know that's the stats, but that may take Kansas and Nebraska and Utah. Like, what? Because I don't see that.
My average home buyer is probably 35 to 45.
Yeah, that's like, I have a ton, like, it's really nice. I have a ton of like high 20s, low 30s.
Yeah, making good money, great credit, but yet they're a first-time home buyer.
Yeah.
Which is just wild, because I know I bought my first place when I was 22.
It was, it was different then.
It was different then, yeah. But now people are waiting until, 30, 35.
I think everyone's waiting for I think the problem with everything, and this goes into home buying, but I'm also going to say it goes into having a kid. Everyone's waiting for manna from heaven to come down and say, now is the time.
Now it's time.
It's not, that's not,
Because it's too late by that time.
Yeah, it's just, you have to have a leap of faith.
Yeah. But like you said, I think people get complacent, and a lot of the younger generation maybe gets worried about, being in one place for too long. They want to be able to be, going from one place to the next.
Yeah, but you know what? They never fucking move.
They never move, exactly. And then rent just goes up every year.
Yeah, all my clients are like, oh, we're like I was to say, like the $7,000 rent. He was like, oh, we're only gonna be here for a year or 2 years. And he's like, oh my God, it's been 5 years.
And you just threw away how much money and lost all that appreciation on a property.
And these are really smart. Like, listen,
they're smart guys.
You're spending $7,000 to $8,000 a month. You're
making good money.
You're making $250,000 to $300,000. 110%. $800. I'm like 800 credit scores. I'm like, I just rented one of our buildings that I own with one of my friends on Rice. Mm-hmm. It's a dump. It's nice, but it's a dump.
Yep.
She makes $280,000 and she has 803 credit scores, and she's paying me $3,000 for a 2-bedroom dump. In the back of my head, I want to grab her. What are you doing? I mean, thank you.
Yes, thank you. I appreciate the business.
I appreciate the money.
Do you want to buy next year? Maybe.
I mean, I don't even, dude. You don't even use me. Get out and get some financial freedom.
It's wild. I talk to people like that all the time. I'm like, wow, it's time for you to move.
Yeah, I mean, just like, and the amount of apps of people that make over $250,000 on a three. You know what? I want to travel. I want to order Uber Eats every night.
I don't want to make you house poor, right? But
I mean, just stop the Uber Eats and the $10 coffees, and and you don't have to buy the new iPhone every 6 months, and buy a house.
Yeah. You'll thank yourself later.
Yeah, they're not even my clients, and I get these applications, and I'm just like, what are you, like, if my mom or dad saw me do that, they'd be like, what are you doing? Like, the first thing my dad and my mom said, like, I left the house, like, I think 24, 25, and I probably stayed a little longer because my dad passed during that time, so I was like, hey, just stay in the house. My mom, blah, blah, blah. She's having a tough time. But when I left, I didn't rent. I left and I bought a place.
Bought a house.
Yeah.
And I do see more and more parents gifting money. I'm going to say at least 50% of my home buyers get a gift for down payment.
And I don't have a problem with that.
No.
I'd rather have them do that than be like, here's money and go piss it away.
Take it and you put it towards something tangible.
Yeah, we have Lee's like, I think I can graduate because my oldest is going to school, college, and he has enough APs where he's like, I think I can graduate in 3 years.
Great.
Well, yes and no. And he's like, I'm like, listen, I go, if you graduate in 3 years, your student, I can't remember the name of it, where I put the money away for him.
Oh, the 529.
529.
Yep.
I said, you'll have some money left over in 529. I said, you could take that money, but you can only buy a building with it. That's all you can do with it. Other than that, I'm taking it back. I said, but stay in school for 4 years. I said, because it's never going to be better than that.
It's a good time.
I mean, I was at Pepperdine for 6.5 years.
Oh yeah, I stretched mine out to 4.5, and then my mom's like, okay,
I got the call. I left one class that I needed. It was my most difficult class. I'm like, I'm going to hold on to this one.
To the very end.
And my dad was like, it's time to go. And I'm like, all right. My last year was business policy, which was a bear. You had to start your own business from start to end.
Oh wow.
Like a bear. And my other two were life
sciences?
No. Lifeguard.
Okay.
And lifeguarding. Like I learned to be a lifeguard.
Oh, like actual lifeguarding.
Yeah.
Okay.
Yeah. In the pool at Pepperdine.
Yeah.
Lifeguarding and volleyball.
Okay. Was it a bad last semester?
The volleyball course, never do this. Kids, I told my son too, never register for a class with the girl that you're dating at the time.
Oh.
Man, because in 4 months, you're not going to be dating her. It's going to be the most uncomfortable situation.
It all worked out. We got Nikki now.
Yeah, but man, that was a terrible month. Like 3 months.
That's
just
some good
sitting
life
there
advice.
and just seeing like eyes. Like,
who are you looking at? Who are you talking to?
Or just like, I hate you and everything about you every single day of my life.
Need a little bit of break.
I was like, Coach, can I transfer? And he's like, what's because of the volleyball coach? And I'm like, why? He's like, that's my ex-girlfriend. She hates me. He's like, he started laughing. He's like, dude, this is the only class I have.
It's a life lesson.
And I was like, it's a great lesson.
Yeah. You look at today, you're still talking about it.
Never make plans with someone you're dating 4 months in advance. Ever. All right, cool. I really appreciate your time,
Thanks
Brad.
for having me.
I appreciate the insight on basically the new things that are going on in terms of 11 or more on the condos.
Yeah, big deal.
Big deals. We talked a little bit about affordability, and really the other one that I liked was being able to buy before you sell and recasting
the loan. Yep, getting rid of the PMI,
the loan,
re-amortizing the payment, lowering the payment.
And you don't. One more question on the recast. You don't need to refi. You just pay.
No, you don't have to refi.
So I don't lose the rate.
You don't lose the rate, nor do you lose, a lot of times on the refis, the bad part about some refis is you backtrack.
Yeah.
Right? Like 30-year fix is primarily interest loaded those first 5 years.
Yeah.
You don't have to backtrack. You make one payment, recast, you keep the original term, the original rate, everything.
That's great. Awesome. All right. So August, good luck the rest of the summer. And
yes, sir.
We do need school.
We need school. Get us a routine back.
I know, isn't it suck?
Yeah, I crave it. I'm gonna give it to me.
What grades are your kids going into?
Fourth and first.
Fourth and first.
Yep. Good times.
Yeah.
They're at summer camp right now.
Away?
Yeah.
First grader too is away?
He's in day camp, but my wife's up in Wisconsin with them. So
just
great.
you?
It's just me at the house working.
Oh man.
I know, right?
That's nice.
But
do you miss them?
Of course, 110%. Yes.
Probably the first 2 days you don't.
First 2 days, no. But then you're like, oh gosh. And even my 9-year-old, who just turned 10, he's like, Dad, it's gonna be 7 days. I'm like, I know. You're gonna be all right.
7 days is fine.
Yeah.
There's people that send fourth graders away for 2 months.
I don't want that. I love my kid. I want to see him.
That's a whole other discussion itself. Because that's what I always say. I'm like, what do you?
Yeah, like I want to be around my kids.
You're not going to see them during the school year.
No,
you
you're
don't
gone.
see them through the summertime.
No.
I know I have to watch what I say because I have a lot of friends that do that, and I'm just like,
to each his own. How about that?
Yeah, I couldn't do it.
It's just not my cup of tea.
No, I couldn't do it. I would be so bored.
Yeah.
I mean, I don't get a phone call now a day and I'm like bored.
Yeah, like what am I doing?
Yeah. All right, cool. We're going to drop this middle of August. So in like 2 weeks, and hopefully rates are lower by then. They won't
Please.
be, but
It won't be. Probably not.
But hopefully. All right. Thanks so much. Make sure you follow us. Brad, give us your information.
Brad Bowden, 773-983-5190, or just Google me.
Google me.
Google me.
Who's the guy that said that? Marshall Falk. My name is Marshall Falk. I was a running back. I was pretty good. Y'all can Google me.
Google me.
Google
Look me
me.
up.
Look me up.
I'm the real deal.
All right. Thanks so much. Bye-bye.
Thanks, guys.